But the reality is decision makers should be reading and using their numbers to make decisions frequently enough that it is predictable. And when they open it, they know what to expect, and it should be telling a story that they already know. And it should be reflecting a story that they've already lived. And to your point, that means if you're still serving a client, but you booked all the revenue in March and it's now sitting here in September, that's not your story, because your people are out there serving that client. And so, when I think about cash-based accounting versus accrual-based accounting, there is a bias to accrual-based accounting. If you want to grow, you need to do accrual-based accounting. That's what your financiers are going to expect. That's what your decision makers need. That is better and more accurate information. And so a ton of bookkeepers out there don't do that, right? That's not what's expected of them. And they just do cash-based accounting, which essentially is accounting for the purpose of record keeping and tax returns, right? That's what it's for.
I've heard a lot of clients saying, well, my tax person, he's an accountant, a designated accountant, said, don't worry about accruals. We'll handle those at your end. And I just cringe.
Yeah.
Right? Like, it's like, sure, because they're not wrong. Right?
No, not when the purpose is tax, for sure not.
But when you bring a management accounting lens to it, they're absolutely wrong. Because what's the purpose of those numbers? It's to help you give comfort around the decisions, business strategies that you want to go into. And so, I don't think numbers should drive whether they're going to have an impact, but especially in the clients that we serve, I think they have. The reason they got into business is they have a really good gut feel on markets and, trends and opportunities on when to chase things and when not to. With that said, if you're taking on too much risk, chasing a lot of opportunities, and you have a really good, set of numbers onto you, that will also slow you down, because it's like, you know what? Like, if I take on too many of these gambles, we're not in a good enough financial position that if some of these bets don't pay off, that we're going to be in trouble. Need to slow down, or at least go find some new money to take those bets on, right?
Yeah. And I think that raises a good point of when it comes to cash flow, another major consideration, and one of our CFOs was emphasizing that just on Thursday when we were having the meeting on marketing and sales. Not every revenue item is the same, and not every profit item is the same. And taking into consideration the impact on cash is critical, right? And so you mentioned it earlier. Obviously, if you have an opportunity to bill up front or do retainer-based billing, that's one way to take into consideration your revenue with a cash flow component. When you take big gambles, like you were just mentioning, like, you score the Costco or the Walmart, but you have to think about that not just from a revenue perspective, not just from a profit perspective, but what's the cash flow that's going to be required, because in order to serve those major deals, the cash has to be spent up front and earned and then collected subsequent. And that stress and volatility and an impact to cash may make that deal not nearly as lucrative as it seems if you only look from a sales and revenue or even profit perspective. So not every revenue and not every profit's the same.